Welcome to ODEON Capital Conversations on all things money and markets with Dick BOVE and MAT VAN ALSTYNE. And here is your host, John AIDAN BYRNE.
On this episode, we look at what really drove US GDP this past summer to new heights. Growth came in at 4.9% in the third quarter. Dick BOVE will explain why the pace of growth was more modest than the numbers appear to show. Where is the US economy now heading? Matt Van Alstine says it reminds him of summer 2008. Dick has the latest numbers out of Capital One on credit card delinquencies and losses on auto loans. China is showing fresh signs of slowing. We'll discuss the ballooning US national debt and how to sharply reduce it. Matt will remind us of the biggest drivers in our escalating debt. Dick BOVE will discuss his reasons for writing an open letter to Morgan Stanley explaining his downgrade of Morgan Stanley stock. JP Morgan CEO Jamie Dimon is planning to sell 1 million of his 11 million shares in JP Morgan, reportedly for tax planning and diversification purposes. Dick will explain why he believes Jamie Dimon's motives are different than Dimon's official explanation. And we'll have more on costly spending on the Green New Deal. I'm with Dick BOVE, Chief Financial Strategist at ODEON Capital Group, and Matt Van Alstine, ODEON co-founder and managing partner. And we'll be right back after this message.
Current and future holdings are subject to risk, and past performance is no guarantee of future results. This podcast should not be copied, distributed, published, or reproduced in whole or in part. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. Securities identified do not represent all of the securities purchased, sold, or recommended to clients. The views and opinions expressed by the ODEON Capital Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions, and ODEON Capital Group disclaims any responsibility to update such views. These views should not be relied on as investment advice, and because investment decisions are based on numerous factors, may not be relied on as an indication of trading intent on behalf of any ODEON Capital Group product. Neither ODEON Capital Group nor the speakers can be held responsible for any direct or incidental loss incurred by applying any of the information offered.
Dick and Matt, welcome for episode 93. The economy, the US economy sped up this past summer. US economic growth surged at the fastest pace since 2021 as consumers spent at a blockbuster rate that analysts say will be difficult to sustain. People are saving less at the same time, but that was quite a growth rate, and we're waiting for the Fed to meet this week. They're expected to pause on interest rates. US consumer confidence dropped for the third consecutive month. We heard that this morning. Meanwhile, in Europe, core inflation, CPI, is dropping in Europe, and prices seem to be coming down here in the United States. Dick, what's your thoughts on all of this?
Well, basically, let's get the numbers straight first, all right? In other words, the GDP for the third quarter rose dramatically. It rose dramatically basically for two reasons. Number one, there was a huge amount of inventory building done by American corporations after a few quarters in which inventories had been reduced in size. The second thing that happened was, for whatever reason, the trade balance got slightly more positive, to the United States. So if you take out those two events, both of which you might call one-time events, the change in the inventories and the change in the trade balance, then the growth in the economy was not good at all in the quarter. And if you take a look at the consumer in particular, in the period from Q2 to Q3, the consumer actually increased spending at a lower rate than it did between Q1 and Q2. So the consumer did not provide the surge in spending, which grew the GDP in the third quarter. In fact, the consumer spending growth rate came down. It didn't go up. And what caused the growth rate of GDP to go up was this tremendous amount of inventory building. So I'd say that what we're seeing from the consumer is pretty much what we expect to see. We expect to see the consumer run out of the ability to borrow a heck of a lot of money, to spend a lot of money, and that's now showing up in the GDP numbers.
Growth hit 4.9%, but you qualified the consumer spending, that the consumers are spending less, Dick, really. There's a slowdown there in consumption.
The growth rate in spending. In other words, the GDP is made up of many numbers. It's not just made up of consumer spending. And the fact of the matter is that the most important number in getting that 4.9% was a $400 billion increase in inventory accumulation. In other words, corporations had not let their inventories remain consistent with the growth in their sales. So all of a sudden, they found that they were behind in terms of growing their inventories. So they bought a huge amount of inventories in the third quarter. That caused the GDP number to go up, by this 4.9%, number. If you take that out and you say, well, what actually did the consumers do? What did the consumers do in that quarter? And to find that out, you look at something called real consumption personal expenditures. And real consumption personal expenditures in the second quarter went up 0.9%. In the third quarter went up 0.2%. So it's very, very clear from the numbers that the consumer did not increase spending activity in the third quarter, and the consumer was not the reason that the GDP number was as high as it was. So essentially, the consumer is doing what we expect the consumer to do. The consumer is saying, I'm running down my cash in my checking account. I'm running down my savings. I'm borrowing a huge amount of money. The cost of borrowing all of this money is excessive. We've said before, your credit card debt has gone from a 12%, rate to a 22% rate. Your auto loan has gone from 4% to 8.5%. Your mortgage rate has gone from 3% to 8%. So the net effect is this is wearing on the consumer, and the consumer is not spending at the rate expected. Now, when the fourth quarter GDP number comes out, it is totally unlikely that you're going to see another big increase in inventory building.
Yeah.
And you're going to see a reduction in spending. And now, to do the thing that John loves the best, my daughter runs 22 UPS stores. All right. UPS earnings in the quarter that just ended were extremely disappointing. UPS was waiting to see what happened in Amazon's Prime Day to see if they should fire a whole bunch of drivers or keep them on. Amazon Prime Day was a huge failure. It just did not produce what was happening. So after Amazon Prime Day, all of the UPS drivers started to see a reduction in their income because they were getting less things to do. And if she's right, they fired a huge number of UPS drivers. So, that's a little smidgen of looking at the GDP from a place where you're seeing, the movement of goods, and that's showing that there's been a major decrease in the movement of goods. So what you have is the GDP number, which is the one related to consumer, slowing down. What you have is UPS reporting earnings, which are well below expectation. And you got this anecdotal piece of information concerning, the fact that UPS stores are not, getting anywhere near the business that they were. Another anecdote from these 22 UPS stores that she runs is that the managers get bonuses based upon how much they outperformed last year's performance, right? Not one of the managers in that system is going to get a bonus, in this quarter, because none of the stores were able to match what they did in 2022. So my take from these numbers are that the consumer is slowing down. In addition to which, if you take a look at the jobless numbers, which come out every Thursday morning, for the first time last Thursday, we saw a meaningful increase in the amount of people looking for unemployment insurance because basically they had lost their jobs. So I think we are on the cusp of the change that we keep predicting will happen. And I think the consumer is not going to be driving the economy in the next couple of quarters.
You said previously, Matt, that you're anticipating a recession in the next quarter or early next year, and this may speak to all of that. Consumers are starting to weaken in terms of their spending activity.
Well, I don't know, predicting is the right word, but historically, when the yield curve inverts, the recession comes around 18 to 24 months later. And so that would be Q4 of this year, Q1 of next year. Historically, that's kind of the range. The one thing that I'm listening to Dick talk about these numbers, and I feel like it reminds me of, the summer of 2008 when going into like the 4th of July of 2008, the numbers look pretty good. Bernanke was out there, talking about how, thought the worst was behind us. And, recessions don't happen in a way where you're like, oh, by December of this year, we're going to have a recession. It's not a hurricane that, it's not a 2020 hurricane where we have satellites that tell us where the hurricane's going, where it's likely going to be. You can measure the speed. This is like a 1900s hurricane, like the hurricane that hit Galveston, where, some forecasters were able to say, well, the barometric pressure is changing. We're not really sure what's happening, but then the next day, Category 5 hits the coast, and that's how recessions happen. They come out of nowhere. They come rapidly. They come quick. It's a change of global temperament. And you got to look around the world and wonder where the optimism is. Real disposable income on this last GDP report was down 1%, and the consumer is 70% of the economy. So what does that tell you? I think Dick's absolutely right. This number looks good because the headline number is large because of inventory building, but you got to ask yourself, why is everyone inventory building? My assumption or gut is that they're inventory building because of price increases. Buy now while it's still cheap to get your inventories because the prices are going up, or at least they perceive the prices are going up. So this isn't confidence inventory building. This is inventory building to get ready for the storm that is coming. Or at least that's what it feels like. Look, I know there's a lot of optimists out there that say this time is different. We have a soft landing. One of the reasons we're going to have a soft landing they constantly point to is that everyone and their dog during the last few years before the interest rate increases went and refied. And so companies that normally would be sitting on, back when I started in finance, they called them 364-day loans because banks could count them as tier 1 capital if they just refied every 364 days. Anything longer than 1 year was lower tiered capital. So companies had exposure to interest rates in a rapid fashion. But, in the last, basically beginning in the financial crisis and since then, companies have been able to go out and get 7-year loans at extremely favorable rates. And so that's the bull case for why this time is different, is that companies and consumers are all sitting on long-term low interest rate debt. And so these interest rate impacts haven't really hit. But when you see real disposable income declining at 1%, when you see wars in Europe and in the Middle East, when you see protests out the streets and it's just hard to put a picture, and you have an actively inverted yield curve that's been flattening the last few months, and you look across the world and it seems like China is slowly trying to peg to the dollar again. It seems like Japan has let go of their yield curve control. They announced this morning that 1% is no longer the ceiling for the 10-year on the JGB. So there's a lot of reasons to be pessimistic right now. And it's, I think our job is to try to be optimistic, but the real world numbers don't look pretty.
As Dick mentioned in the past episode, auto delinquencies are up, credit card debt is soaring, and just as a host of other macro problems out there, China's economy is showing fresh signs of slowing as well, Matt, and factory orders are down. Construction activity has stalled or slowed in China. And just picking up on China, what you also referenced there, Vladimir Putin earlier this month met privately with Xi Jinping in Beijing, attending the Belt and Road Initiative Forum. Here's an interesting stat. China's exports to Russia have soared so far this year by 57%, and the Chinese currency accounts for almost half of all foreign exchange trading in Moscow, up from 0.4% in January 2022. And China is now also the largest importer of Russia fossil fuels, which gets to this whole idea that you spoke about in the earliest episode, Stick, of the bifurcation in the global economy. Everything is changing. It's an entirely different global geopolitical dynamics. It's changed everything.
I think it has. I think that, in fact, I had an opportunity to speak with James Gorman earlier this week. James Gorman is the CEO of Morgan Stanley, and he was pointing out to me that Xi Jinping is so worried about the Chinese economy at the moment that he's now started to attend groups of financial meetings in China, which he has never done before. In fact, he said that even the previous premiers of China have never attended these meetings. So he believes, at least, that Xi Jinping understands that China is running into a financial difficulty, and China is now starting to try to do something to reverse it. But in terms of the broader issue, I think that you're right. With the bifurcation of the world economy on a political basis, we're getting a bifurcation on a financial basis. And therefore, the amount of financial transactions that were done in the dollar is still the dominant, world currency. And there's no indication at this moment that it won't continue to be. But, if one takes a look at the percentage of transactions that occur in the dollar versus other currencies, the euro, the yuan, the dollar is not maintaining its position, and it is being pushed back, which has, I think, very negative implications for the American economy and for American companies.
A new poll by Harris conducted for Bloomberg News said, despite strong growth and a strong job market in the US, I guess you could nuance that. I mean, if you look underneath the hood, more middle-class Americans are worried about the state of the US economy than a year ago. And one of the reasons cited by these middle-class respondents was the rapid rise in interest rates. 57% of middle-class respondents said higher rates and higher borrowing costs were having a negative impact on their household finances. Consumers are feeling the pinch in the US, at least the middle class.
Well, Capital One came out with its earnings, last week. Everybody's coming out with earnings right now. It showed that the failures to pay, the delinquencies on the credit cards, had gone from 2.2% to 4.4% in just 1 year. It just doubled. The losses on auto loans, and this is just for Capital One, the losses on auto loans went from 105 basis points to 177 basis points. And the losses that they were taking on commercial loans were up 25 basis points. So, this is one company. I mean, obviously one of the biggest companies in America, and certainly one of the biggest consumer lenders in America, but they're very clearly showing that there has been a significant increase in the amount of loan losses that they're absorbing because the consumers are having difficulty making payments. There was an article in, I think it was The Economist, or it could have been the Wall Street Journal, in which, they went out and interviewed a whole bunch of people who had just had their cars repossessed. And basically, they were indicating that they just couldn't make the payment. Bottom line, they couldn't make the payment on the car, so the car had to go. I'm very much in Matt's camp. I'm very much in the camp of being very deeply concerned about where the economy is going.
Given all of that and where the economy seems to be going by your telling and Matt's telling, most analysts are expecting the Fed to pause at its meeting this week. Have they done their job? I mean, the markets seem to be taking care of interest rates, at least on the long end. Borrowing costs have risen. So where does the Fed move from here? What does it do?
Well, in my view, you don't take a look at these meetings as an indication of what the Fed's going to do. You take a look at what the Fed is doing by looking at their balance sheet. I think this Fed is trying very hard never to surprise anybody, all right? And therefore, they're trying to lay out the path of where they're going And, if 98% of the people out there think that, the Fed will not increase rates, in the meeting tomorrow, then I think it's fair to state they won't, because if they do, it will be a huge surprise, and it'll be a huge negative surprise, and the markets will react violently on the downside if they do it. However, they are leaving the door open for a rate increase in December. And they again are cautioning people that we may increase the rate in December. And the reason that they're leaving the door open is these personal consumption expenditure inflation numbers were very disappointing in the sense that everyone expected that this downtrend that had been established over the last few months would continue, but it didn't. Inflation was 3.7% in the latest numbers that were produced. So the point is that if the Fed really does believe that personal consumption expenditure inflation, a lot of words, PCE inflation is the key variable that they're going to follow in terms of seeing whether inflation is coming down, it's not coming down the way they wanted. And it's still well above the 2% target that they're looking for, and therefore it is likely that they're going to remain tight. But again, I started this off by saying, look at the Fed balance sheet. What are they doing with their balance sheet? Well, they're shrinking it, and they're shrinking it every week. They shrunk it by another $25 billion last week. Every week, they're taking that number down. They've taken it down now by over $1 trillion. And they're showing no indication whatsoever of easing up on shrinking their balance sheet. The money supply numbers come out a month delayed, but the money supply numbers which came out at the end of last week showed that the money supply is still shrinking at the rate of 3.5% on a year-over-year basis. So, and the deposit numbers, which the Federal Reserve puts out, and they put that out on a Saturday, they're showing that deposits are still shrinking in the banking system, despite the fact that they're paying huge, yields to get, big, people who will invest 100,000 at a clip to get those people to come back, so the Fed balance sheet is coming down. Money supply is coming down. Deposits in the banking system are coming down. There is no indication of the numbers that are produced in the financial system that the Fed is easing or about to ease or is backing off in any way.
Yeah, I think the Fed, I feel like I say this every week and I feel bad for repeating it, but the Fed's just going to keep doing this until they break something because the market's allowing it. But this is, it's to me, I'm just shocked that they're continuing to do this. When you look at the fiscal side of things, the U.S. Treasury is going to be refinancing debt at these new 4% and 5% rates, and the percent of GDP that goes to fund the debt is going to cross over 10% soon of GDP just funding the debt. You have a fiscal deficit problem in the United States that's clearly, in my mind, not being helped by the Fed's actions, and yet I'm just astounded they're continuing to do it. But I guess they're going to keep going until the markets force a reversal, and they're going to declare victory and say we went as far as we could.
I think you gave us a number, Dick. It's out there, obviously. Debt servicing costs annually now at over 600 billion.
Yes,
in that range.
Yeah, it's in that range. It was the single biggest increase in the federal budget last month. Was the interest payments on the debt. It wasn't Health and Human Services payments, and it wasn't payments for Social Security benefits.
Defense and yeah.
Mm-hmm. It was interest. Matt turned me on to something last week, which I've been having a lot of fun with in the last few days. There is something called the Committee for a Responsible Federal Budget, and if you can go on the internet and you can see it, and in that website, there is something called the Debt Fixer Web. And what the Debt Fixer Web does is it provides you with a series of departments of the government, or just about 4 or 5, and it then underneath those areas, it basically tells you how much money would be cut off the federal deficit if you did A, B, C, or D. For example, if you eliminate the Tax Cut and Jobs Act of 2017, you actually would save $2.9 trillion, assuming you didn't create a recession by doing that. If you took the corporate tax rate up to 28%, you would get 1.2 trillion, and of course that would eliminate the deficit. If you raise the retirement age to 70, to 70, you would get another 190 billion in savings. If you made people who earn greater than $250,000 to continue to pay their Social Security tax, it's something like I think it's 1.6 trillion. But what you can do, is they let you go onto this site, you click the things you think should be done, and you come up with a net number. And then you send that net number, you send your opinion with the net number to either the Republican Party, the Democratic Party, or I don't know, some third, probably it's their own site. And it is really fun to do because, there are all sorts of ways, to affect the deficit in a positive fashion, none of which it is likely that the U.S. Congress will do. So the point is, you can express your feeling as to what should be done. If you limit the increase in non-defense spending to 1% a year, you save $330 billion. If you get rid of farm subsidies, you save $250 billion. If you require the states to pay 25% of the food tax, of the food stamp cost, you save $250 billion. And, if this thing goes on and on and on, because it allows you to take a close look at how the deficit is been created, what can be done to eliminate the deficit, and it gives you the opportunity to express your view, your opinion, and put it in there. The tragedy of this piece is that nobody's going to do any of it. The deficit, the estimates of the deficit are still relatively high for both the third and fourth quarter of this year, and but there is a way to get out of it. We're just not going to take it.
And it's called the Debt Fixer web device.
Yeah, the Debt Fixer web device, but you find it. I assume if you type that in, you get there, but it is found in a website called Responsible Federal Budget Adjustments, or Responsible Federal. Just go to the federal.
By the way, when I play around with that, the ways there's so many. It's a fun thing. I wouldn't call it fun because it's actually extremely depressing. One of the ways that you can actually solve a lot of the problems for the feds is by transferring, the federal payments like education grants or Medicaid grants or Obamacare grants or food stamp grants to the states, just by having Congress just push them off to the states. And I was like, that's one of the easiest ways to do it, but that doesn't really solve the problem, because if you live in the states, you're just going to have, your state taxes are going to grow. And so it might be an escape valve, but it's a real problem. This, we're at debt to GDP that's rapidly growing. And I don't remember if it's this website or a different one, but one of the things that really shocked me was, there's two budgets in Washington. There's the on paper budget, and then there's off budget spending. And it's the off budget spending where a lot of this deficit creation is coming from. The bill that Joe Biden proposed to support, I believe, Ukraine, 70 billion, I think 10 billion to Israel, something for the border wall. It's 105 billion. And that's they're just writing a check for if this gets passed. It sounds like the Congress won't pass it, but the gall to go and spend 105 billion of just straight up debt. That's how Washington works, and it's off balance sheet. And so when you hear the announcement that they've passed a budget and the debt next year is going to be 1.6 trillion, you can't believe that number, because there's the off balance sheet stuff which adds another trillion. I mean, we're talking about this year we're going to add over $2 trillion of debt, and we're not in a crisis. We're supposedly in a growing economy where unemployment is phenomenally low. This is the time historically where the deficit shrinks, and even during the Clinton years, the debt even itself shrank because they were able to keep everything within the budget. But right now we don't have anyone in Washington at all, it seems like, focused on this or even have it as a side issue. This seems to me like the biggest issue confronting America, and I know we have a lot of issues overseas, but once you trip over an economic crisis and you become hyperinflationary because you're printing money to pay your interest and pay your debt, it's really, really tough on the economy to get back from that. And it's really tough if you don't have serious people in Washington, and it sure seems to me that we don't, working towards it. And I'm very pessimistic. That said, I know that I've been pessimistic for a long time and I've been wrong for a long time. So I'd love to be wrong on this one as well.
I think also under Clinton, he managed to get the deficit and budget under some kind of control. A couple of weeks ago, and I hope I'm not misquoting him, but Larry Fink of BlackRock, who leads BlackRock, a huge, massive, influential asset manager, said the only way we're going to get our debt down is by growing our way out of it. We can't cut our way out of it. I was surprised by his statement. He doesn't believe in cutbacks.
It's not that he doesn't believe in cutbacks. He doesn't think that they could occur. And by the way, you were right. The net interest on the debt last year was $659 billion. That's what that was what you said. But the point is, what he's saying is, you can't get the American people to elect people to the American Congress who are going to cut anything. They're just not being elected, right?
Yeah.
So you got to look at the other side of the equation, I guess. Because if you take a look at where does the government get its money, 49% of it comes from, the income tax payments made by individuals. Another 9% or 10% comes from income tax payments made by corporations. But another 35% comes from all of these Social Securities, Medicare payments of that nature. So if you cut it down, where the payments are coming from are really from the American people. If you take the 49% and the 35%, forget the corporate tax payment, you're up to 85% of the revenue of the United States government coming from individual taxpayers, across the country. And my belief is they're going to get hit. They're going to get hit with a tax increase, whether it's a Republican or Democrat that's elected next year, because what you said, Larry Fink said, makes sense. They're just not going to cut anything. They're just not going to cut anything.
But I often wonder, Dick and Matt, where is the common sense in American society? I mean, there's wasteful spending at the local municipal level. Education in a lot of jurisdictions is gobbling up a huge amount of taxes, people's personal taxes in districts in New York and New Jersey. Maybe there's room for reform at that level, but you could leave Social Security alone. I think you should leave Social Security alone, but it could be reformed, certainly. But aren't there other ways, so much waste, highways to nowhere, boondoggles, subsidies to various industries?
I'm sorry, everything you just named is part of the discretionary part of the budget, which is not where the problem is. There's three main parts of the budget that have a problem. The biggest one, and the rapidly growing one, is the interest expense, which is because of the debt, and the debt being refinanced at high interest rates, and the debt being significantly higher than our GDP. So interest expense is the big one. Defense spending is the second big one, which, historically, our defense spending, I believe this year is going to be around 2.5% of GDP. And as recently as 1980s, we were spending more like 6% of GDP on that. And then the big one, and this is, the monster that's just growing rapidly, and it's not going to get any better until someone comes and fixes it, is transfer payments. And that's just your Medicare, Medicaid, and Social Security, where you're taking payroll taxes, which are capped at least for the Social Security portion of it, at I think 14.4% of your income, up to about $140,000. And those three items alone, defense, interest, and transfer payments, add up to more than 100% of tax revenues. When we had the budget shutdown, or the government shutdown, it was looming, and Kevin McCarthy lost his job because he cut a deal to keep the government open. The line in the sand was, we're not going to touch it. They can't touch interest payments because that's dictated by the market and dictated by the reality of what debt has been issued. They could touch defense, but apparently zero appetite from anyone in Washington except for maybe one congressman to cut defense spending. And then Social Security is the third rail of politics. So the three main, everything you're mentioning, you could cut all of that to zero. You could cut 100% of the discretionary budget to zero, and this conversation would barely change because it would still be a massive problem.
An interesting data point on Social Security. A single person earning $47,800 in 2015 and retired in 2015 would have paid $272,000 into Social Security and receive about $294,000 in lifetime benefits. So if you suggest or propose to the American people we're going to mess around with Social Security, that one of the first things they think about, it's the people's money. You're messing with our money. I mean, is there a way around it? Maybe you mentioned taxes, Dick, or what other reforms would work politically and in a sensible way?
Well, again, there are sensible things that can be done, but I don't think any of them will be done. But I think the thing that should be done more than anything else is raising the retirement age to 70. Because basically, and we said this before, back in 1938, nobody expected people to live on average to be 72 to 73 years of age. They expected them to die, around 65 age. And essentially, therefore, they voted, you don't get Social Security until you're 65. People don't die at the age, thank God they don't, but people don't die at the age of 65. And we continue to make these payments to them that they didn't put the money in for, that they didn't earn. And that's got to stop. I mean, we're wasting the productive capability of all of these people in the first place, because, when they're 65, they know what they're doing, and they know how to handle their jobs, and they know how to get productivity out of what they're doing. But instead, they get to retire and do nothing. And instead of creating value for the economy, they take value out. But in France, as you know, earlier this year, they attempted to increase the retirement age to, I think, 63, right?
And I think it's 62. They raised it from 60.
And then there was riots on the street.
Yeah.
But they did succeed, Dick. I mean, you said attempted. They actually did change it, and the riots ended.
No, you're right. Macron is a tough guy, and he made it happen. But I mean, who's gonna do it here? Who's gonna take steps and say in 2026, 2028, 2030, we're going to increase the retirement age by 1 year until we get to the max of 70, and we'll leave it there. I don't think anybody's going to do that. The second thing that should be done is that you can't cap Social Security payments. They've got to run, you got to take this percentage as long as people are earning the money. That provides another major increase in income. But again, any thought of doing that will create tremendous, kickback from people who are getting off paying the Social Security payments by the middle of the year or by the third quarter of the year. The whole issue of pushing the certain of these Medicare payments back to the states, Matt's correct. It puts a real burden on the states. The only point is the states are not going to pay the same amount that the federal government is paying. In other words, my guess is the state legislatures are going to, reject making the payments at the level that we see now. So, I mean, there are things that can be done, but, this is a democracy, and the American public have made it clear to their leaders, whether they're Republican or Democratic, don't touch spending. No, just keep spending. And therefore, that's in essence, if we took the personality issues out of what's going on in the House of Representatives, at the core, that's what they're fighting about, that we want to touch spending. And I think that's the correct view. And I would hope that view does become the dominant view. But I mean, you can see the fights that we're having now over that issue.
I would point out that, like, in 2008, as much as we might have different opinions around the world, or at least politically, about TARP, the Congress passed TARP within weeks of the crisis happening. And in 2020, when COVID shut down the country, and the governors and the president, did the whole 2 weeks to flatten the curve, and everyone stayed home, and consumer spending fell off a cliff, and unemployment skyrocketed within, days and minutes of that announcement. Like, the entire economy went down to a halt. You had a very controversial President Trump leading the executive branch. You had a very controversial Nancy Pelosi leading Congress, and yet they got the PPP bill done in rapid fashion. A few weeks ago, I was reading the history of when Ronald Reagan got the Social Security changes through in the early 1980s. And I didn't realize this until I read this. I assume my source was right, that the Social Security checks were set to basically drop 20% that next week if they hadn't fixed it by law. And so I guess my optimism is that, and you say this a lot, Dick, that America always does the right thing after it's exhausted every other option. And the Social Security Trust Fund is going to run dry. Right now it's predicted to run dry in 2032, but I presume that some point between now and then we will have a recession, which will actually rapidly bring that date in. It's going to be more like 2029 or 2028 when all is said and done. And at some point in time, the Congress will get serious and fix these things. But right now, I guess they're just coasting because times are good and life is fine. We're talking about 4% GDP, and even the Atlanta Now forecast is for the Q4 is still predicting 2.5% growth in Q4. So nothing brings people together like a crisis, and maybe that's what it'll take for this government to finally get serious about the problems in America.
And part of it too must be the demographic crisis in America that we've spoken about. Not enough workers coming in to shore up Social Security and other outlays.
Yeah, I mean, the question really is, and going back to the website Dick was talking about, is you can fix the revenues. It's hard to imagine how you fix the revenues without harming the economy. And this is how Art Laffer got famous on his famous Laffer curve, when there's a point where you can raise taxes so much that it actually reduces in the tax revenue because it harms the economy to the point that even at higher rates, you're not going to collect as much money. I mean, you can go to the extreme and say, okay, if we're going to tax 100% of income, well, you can imagine how many people are going to get up in the morning and go to work. No one. And so 100% of nothing is nothing. And so, going back to the other side, you could tax 0% of income. How many people would work a lot harder at 0%? I imagine a lot of people would work a lot harder at 0%, but then you wouldn't have government funds, and you need to have that balance. The real question is, can you fix it on the revenue side? And, my hunch is that you can around the edges, maybe on capital gains, maybe indexing capital gains, but, the real solution is going to come to reducing beneficiary benefits for Social Security. I mean, that's what they're going to have to end up doing, is putting some sort of net worth ceiling or income ceiling so that certain people don't get Social Security anymore. They're going to have to, somehow link the age of when you can first take it out to, expected life, because back when it started, I believe your benefits kicked in around the time of the average longevity of humans at that point in time. Yeah. But since then, it's grown 20 years and the benefits haven't grown. And then, the benefits haven't changed, even though you get to draw down for multiple decades, whereas before you're predicted to draw down for, a handful of years. And so there's ways to go about fixing it, but it's got to be really done really smartly, because you could actually destroy the economy. The one that really stuck out at me is on that computer game was if you put a VAT tax, which is basically a sales tax, national sales tax on producers. That's the fastest way that I saw that you could just quietly just generate a ton of revenue. Putting on a 10% VAT tax on everything, but it's a regressive tax, and that's one of those taxes that Democrats don't really like that much because it actually hits the poor a lot more than income taxes do. So it's a tough problem, but there are solutions if we just had serious people. And I just don't think they're going to get serious until the crisis is on the doorstep.
And just to be clear, you're not advocating the elimination of Social Security, the reform and shoring it up, making it stronger, right?
Well, I'm not advocating anything. I'm talking about the various tools that you have. You have a revenue problem where they're going to run out of money. You have a spending problem where they're going to run out of money, and you can either cut the spending or you can increase the revenues, or you can do a combination of both. And, eliminating Social Security is, you
to use your own phrase, mass suicide.
Probably, yeah.
Also, Social Security benefits have lost 40% of their buying power since 2000, according to a report by Senior Citizens League, despite the COLA increases recently. So recipients are not don't have the same purchasing power with Social Security today that they might have had a generation ago, which was kind of interesting.
Yeah, I mean, but that's how you're going to have to solve the deficit problem too. I mean, what you're really doing is slowly making improvements to the balance sheet issue that we're talking about. And, that's one reason I've kind of thought that they're going to do yield curve control eventually, because the way to shrink the deficit versus GDP is to inflate the currency and inflate GDP so that the debt in real terms shrinks because of inflation. And it's a hidden tax on everybody, but it's a way to get out of it. And it's kind of the roadmap they used in the 1950s to get out of the inflation problems back then.
Dick, you said you've been talking to James Gorman at Morgan Stanley. Of course, there's changes coming there. The current co-president, Ted Pick, will replace James Gorman in January. And in the meantime, you've published a really fascinating open letter to Morgan Stanley explaining your downgrade of Morgan Stanley stock in greater detail and just summarizing some of it, and it's quite detailed. The succession issue is important, but there were multiple issues you wrote about, and I guess the geopolitical changes in the world, from Ukraine and what's happening overseas to the global pandemic and the money supply, are a big part of it. It seems that you feel that maybe Morgan Stanley has not positioned themselves properly.
Yeah, well, in other words, I think that unfortunately, Morgan Stanley is like every other company out there. They're looking at the trees all the time. What's the revenue coming in? What's happening? With the monthly budgets, etc. And I don't think that most of these companies look at the forest. What is going on overall? And so I outlined, I think it was 4 areas where there's been a major change affecting the business of financial companies, Morgan Stanley included. The first one is, of course, the political bifurcation of the global structure. And you started off by saying it, John, when you said that X percentage of the transactions between Russia and China were in Chinese currency, not in, the dollar. 20 years ago, that would never have happened. It would have happened, ever since any time since China joined the World Trade Organization. So the first point is that this splitting of the world into 2, if you will, blocks, and we'll put on one side, Europe and the United States, and on the other side, we'll put China, Russia, Iran, North Korea, and a number of other countries that would surprise you. But anyway, those countries were all working with the dollar. They're not all working only with the dollar any longer. So the size of the overall market is not as great as it was. The second issue that I raised was that, from 2019 to the middle of 2022, we increased the money supply by $7.5 trillion. Now, we always talk in big numbers, and therefore the numbers don't mean anything. But $7.5 trillion is a 50% increase in the money supply in 3 years. And, that had a huge impact on, inflation, number one, of course, but also on a whole bunch of financial businesses, because the money just kept flowing in. It just kept flowing in. Now, since the middle of 2022 to the present time, we have cut the money supply by $1.25 trillion, 3.7%. So we've gone from creating a massive amount of money, which can be used by everybody, and which, if you take Mr. Gorman's view, the rich get richer and the poor don't participate. The fact is that the money was out there, and it was growing the financial sector. And now the money is not out there as much as it was, and it's being pulled back. All right. So that changes the nature of the financial business that his company and other banks are dealing with. Then, you get to the third issue, which essentially is the US government, and they like to call it now banking March Madness, not basketball March Madness, but banking March Madness, because you had 3 banks go bankrupt in that month. And basically speaking, what the government recognized then was they have to protect themselves. The government cannot support the banking industry, to the extent that was, stated by the president. You cannot back $19 trillion in deposits with, 200 billion, we'll say, in defense fund. So the government is now pulling the strings tighter around the banking industry, forcing the banks to give up certain businesses and forcing, if this rule goes through, and forcing them to change the way they do business. And that's also not being reflected by these companies. And then, of course, the fourth one relates strictly to the asset management business. You've had, I'm going to say, thousands of money managers crop up in the last, 10 years because of the growth in money supply and the cost of money. And, they keep cutting the prices. In other words, 10 years ago, if you put money with a hot money manager, you would pay him 2% of the money that you put there, and you would take 20% of the profits, that individual made, for yourselves. No one's doing 2 and 20 deals anymore. People are fighting to get 1%. So my belief is that the structure of Morgan Stanley's business, and by the way, we do not have any, relationship with them that would be, making us have an opinion one way or the other. But, the structure of Morgan Stanley's business is, number one, they know what's going on in the Far East. They've reduced their position in China dramatically and keeping now a group in Hong Kong, right? Jamie Dimon's doing the same thing in China. So they know what's going on there. They're completely ignoring what's going on with, the money supply shift. They're completely ignoring that the government has got its own axe to grind here in these new rules that are being put out. And they're completely ignoring the fact that there is a very large amount of money managers out there, and that, it's not going to be the price any longer. It's going to be who's got the best performance. And it's going to be tough to be the best performer in a market which I think is going to be as rocky as this one. So that's what we were trying to outline, not just to Morgan Stanley, but to all financial companies. And again, I can't have a podcast without mentioning Jamie Dimon. He made the decision last week to sell 1 million shares of JP Morgan stock. To my knowledge, and I've been following this guy for, well, the first time I met him was, was in the 1980s, when he was working with Sandy Weil. I don't ever remember him selling any stock that he owned in a company that he was operating in. I don't ever remember him selling JP Morgan stock. I don't ever remember him selling Bank One stock. I don't remember him selling commercial credit stock. I don't remember him selling Citigroup stock. And now he's selling 1 million shares of JP Morgan stock. Now, obviously, the reason is always, to estate plan issues. But the fact is, I don't believe it. I believe that this guy gets up and says every time he makes a presentation, the world is in a riskier place than I've ever seen it. Things are really, tough. If you think about the financial system, the political system, and then all of a sudden he sells 1 million shares of his stock. I put those two things together, and they worry me. Okay.
His official reason, you don't buy that. He sees a lot of dark harbinger of fear, as it were. Interesting. But this is also, it's 1 million of his 11 million shares. So he plans to eventually sell the other 10 million or whatever it is.
I'm not inside his head. I can't tell you. But if he would have, I do know that if he were to say, I'm selling 11 million shares of JP Morgan stock, for estate planning purposes, the price of JP Morgan stock would be down 50% within a couple of minutes of him saying it. So the point is, he doesn't have the freedom to sell 11 million shares of stock because he'll destroy the value of the stock. But, if he makes a second announcement after he sells his first million, that he's selling another million, I would say watch out.
So we should, and he's the longest serving CEO of a major US bank and a protege of the incredible Sandy Weil, who built up Citi.
Yeah, I don't think Sandy Weil was incredible, but
no. Well,
I think Sandy Weil destroyed Citi, but that's that he was incredible in that fashion.
Okay.
But Jamie Dimon is incredible.
You do mention him frequently, and he became is this fair? He became a billionaire during his tenure at the bank because he grew the stock. Yeah,
well, I mean, and that's the other thing. I mean, Morgan Stanley really was infuriating with one of the things that they did. They made bonus payments. There was a succession battle that I wrote about and said that they had to end, and they did end it. But when they ended it, they paid $20 million to each of the three people who were running, for the job of a CEO. The winner got $23 million. And then they paid $31 million to James Gorman, which I guess is his regular salary. That's $90 million to four people. The stock value, I think the value of Morgan Stanley stock went down a few $billion in 2023. So the shareholders walk away with a couple of $1 billion taken out of their pockets, and the people running the company run away with $90 million gotten from the shareholders. I don't think it's right.
Eye-watering numbers. Matt and Dick, you've been talking here and giving some interesting insights on the green energy and the Green New Deal. And Dick, you referenced a fascinating book by a French author recently. I must note that New York State residents may be hit with higher bills because of higher energy rates expected with the move to renewable energy. The use of wind farms. You mentioned that, Dick, or not Dick. Well, Dick probably mentioned it, but Matt also mentioned it. And global fossil fuel subsidies last year grew to a staggering record of $7 trillion, about 7% of global gross domestic output. So what's the risk return here? Is it a good investment in the long term?
Well, it's very hard to say, because if you believe what this guy Guillaume Pitron has said, renewable energy costs more than fossil fuels, and if not just in terms of the actual outlay to put the renewable energy in place, but in terms of its future, if you will, cause of deterioration in the economy. What am I trying to say here? That the pollution control is not going to be as great as if you stuck with fossil fuels. So I'm not sure how well people have thought all this stuff out as to whether making these expenditures are really going to save the green world, or whether in fact they're just doing something because they're doing something in order to deal with this problem. It doesn't seem to be the right solution.
I'm going to paraphrase Rishi Sunak, the Prime Minister of Great Britain, of the United Kingdom, when he kind of rolled back, because they have this vision of, they had these goals for 2030 of greenifying their economy. And when he rolled them back, and I think he pushed them back to 2035, but it felt more like he was going to abandon them altogether, the emissions goals, was that if they reach their goals, hypothetically, that over the next 7 years, that they'd be displaced by about 3 months of increase of emissions in China alone. And then he's like, that's not to mention India or Africa. And so what you have right now is, the West is kind of committing some sort of deciding in advance that we want to be less competitive because we're going to use the most expensive forms of energy known to man. And at the same time, the developing world is offsetting all the green savings that we're accumulating while becoming more competitive. And so it's not sustainable in the long run. And, the faster people realize that and get there, the faster, we're going to see a resurgence in, I think, nuclear, because nuclear is green. It is abundant. It is cheap once you get through the upfront capex, and it's long-term, long-lasting, and sustainable. And yes, there's issues with the spent fuel rods, but they're not the same issues as the emissions that are caused in creating fossil fuel emissions, and in even the type of coking coal that you have to use to manufacture windmills or get the silicon for the solar panels. It's all very environmentally intensive, and I think the gig is up at some point, that it's not going to work, and hopefully sooner the better, because I think our economy could use cheaper energy.
Yeah, you said something at the beginning of those comments that made me think of a totally different subject, but that is, all the people at the auto workers have won their battle, and all of the consumers are out taking a look at how much Nissans cost. They ain't going to buy American cars.
Exactly.
We can come back to that next week. I'm going to put in a program note here. Mark your calendars, because we will have a live webinar on Wednesday, November 8th at 2:30 p.m. Eastern Time with Geek Skeezers and Googleization, hosted by Ira Wolf and Jason Cochran. You'll have Dick and Matt and myself. That's November the 8th at 2:30 p.m. It will be available on LinkedIn, YouTube, Facebook, and Twitter. If you need more information or want us to send you that link, email us at podcast@odeoncap.com. That's podcast@odeoncap.com. And that's it for this week. A great conversation, Dick and Matt. We'll be back next week for episode 94. And until then, take care.
Current and future holdings are subject to risk, and past performance is no guarantee of future results. This podcast should not be copied, distributed, published, or reproduced in whole or in part. Information presented herein is for discussion and illustrative purposes only, and is not a recommendation or an offer or solicitation to buy or sell any securities. Securities identified do not represent all of the securities purchased, sold, or recommended to clients. The views and opinions expressed by the ODEON Capital Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions, and ODEON Capital Group disclaims any responsibility to update such views. These views should not be relied on as investment advice, and because investment decisions are based on numerous factors, may not be relied on as an indication of trading intent on behalf of any ODEON Capital Group product. Neither ODEON Capital Group nor the speakers can be held responsible for any direct or incidental loss incurred by applying any of the information offered.